Hi everyone, welcome back to Be Rich. It's me Vinod here with Shashwat, and we have something interesting Shashwat had shared with me over the week, which we were discussing. And without wasting much time, I let Shashwat talk about this. Then we can discuss this further. Shashwat, what did Charlie Munger say, which is so important?
Yeah. So Charlie Munger, unfortunately, is no longer with us, but his wisdom continues to be with us. Let's look at 6 lessons I learned from Charlie Munger that I think will be important. Some of these lessons are not lessons we've covered before, so I hope that all of you continue watching this video. So, the first point which I wanted to bring up was that this is something which everyone knows about, but Charlie Munger's success comes from holding two big businesses with a holding period forever. And his first big business is, of course, Berkshire Hathaway, and his second big business is Costco. And there is a quote which Charlie Munger says: At Berkshire, we have a simple problem of estate planning. Just hold the goddamn stock. So I'm sorry for my language there, but this is a direct quote from Charlie Munger. And he usually was unfiltered when he spoke. And this quote makes a lot of sense. And he says that just holding the stock is all we need to do to have estate at Berkshire Hathaway. And I think this is very applicable to us as investors as well. A lot of us have been discussing many points about, should I hold for this long? Should I hold for that long? Should I buy this company? Should I buy that company? What is my holding period? When should I exit? These are questions which have popped up everywhere. But the main point here is to buy businesses which you don't need to sell. For example, I don't want to beat a dead horse, but let's look at ITC because it's the trademark of what we have been talking about on this channel and our other channels. It's a company which I recall my uncle holding for over a decade now in my own memory. I'm sure he's held it for longer, and it's a company which he has never once thought about selling. These are the kind of companies which you should be investing in, companies which are fundamentally strong, which have good management, and which are companies with solid businesses that you will be comfortable holding for a long period of time. So, what do you think about this first lesson?
I completely agree, especially if you have this mindset. You're not buying it for yourself. Let's say you tell yourself mentally, whatever I am buying today, it's going to be there till my grandchildren decide what to do with it. Right? That means we're talking about a time frame of 40 to 50, 60 years from now. And if you look at it like that, and if you are very serious about that, and you have the mental fortitude and the psychological mind frame to do such a thing, then you don't have to worry about is it the right price. You don't have to worry about PE. You don't have to worry about anything other than which business you want to buy. As Warren Buffett said, it's about not investing or stock, it's about which business you'd like to buy. He very famously said, Warren Buffett, the biggest difference advantage you have over someone like Rockefeller is when someone like Rockefeller got to the oil business, he could not switch businesses. He was invested. He was completely in oil. Ford, when he got into motor truck, he was completely into the Ford motor car. But he says today, thanks to the stock market and how easy it is and flexible it is, you as a businessman can decide today I will be in the oil business. I don't want to be in the oil business anymore. You can vacate and move into technology business. So if you have that mental frame of mind and you're buying a business like that, then it is tremendous because you can buy anything and you can hold on to it and it can turn into gold given 60 to 70 years time. But like I said, it is not in your lifetime that the fruits will be there. These fruits will appear much later, generations to come. To have that kind of a mindset, I've only seen very few families in India have that kind of a mindset publicly spoken. That is, those are the Godreges, those are the Tatas who have this kind of a mindset where they see whatever they do it for generations ahead and they don't do it for their own self consumption. They never worry about them. They always are building towards the future, and that takes very different mind frame to do, is what I feel.
That's great. So let's move on to the second lesson. The second lesson, which I've picked up from Charlie Munger, is that there is a pitfall of overthinking. So I'm going to repeat this: there's a pitfall of overthinking. Investors often, very often, try to optimize or analyze or even overanalyze their portfolios, leading to people selling too early. And a lot of us have sold companies which we wish we had held on to for longer. I am party to that, and I'm sure if any of you have watched the Sashwat Breaks It Down series, you must have seen my errors in how I sold too early, and I regretted it. And this is a lesson I learned from Charlie Munger, and I hope all of you at home will pay attention to this exercise. So, what do you think about this lesson I've picked up?
This is very true. This case in point is right now what is happening with the Hyundai IPO. Hyundai IPO, the price band it was launched at was very expensive. It was very apparent, and that's why Anand was very clear on saying, don't bother applying for this IPO. You might as well pick up the stock if you're really keen on it much later once it starts trading. But a lot of people did apply, and they managed to secure the IPO subscription was at 1. It wasn't in any multiple. So anyone who applied for it got been allotted the shares. So now when the shares started trading today, you noticed it was down 3%, 4%, and everyone's wondering, what do I do? This is where the case in point comes if you're overthinking. If you bought the share of Hyundai saying that this is a great car company, I've bought these cars and I like these cars, I like the customer service, whatever said and done, I think they are a fabulous car and they've been in India for a long time. And like the first rule goes, I'm not going to sell this share at all. I'm going to just hold on to it and forget about it. Then you don't need to worry about the market news. You don't have to worry about all the noise which you hear saying the share is down on the opening day by 3%, 4%. Then read all the stuff. Should you buy? Should you hold? Should you sell? You won't be listening to any of that and saying, okay, I'm going to be holding this for Hyundai for 30 years. I don't care. Because if you're holding Hyundai India for 30 years, trust me, you will have nothing but happiness at the end of those 30 years. With all the dividends which are there in future, all the bonus, all the splits, everything put together, 30 years from now, Hyundai, whatever price you bought, it will be in multiples. But the problem is like what Shashwat says, you overthink it. You'll immediately see the market news. You'll see it's down 4% on the opening day. Then you'll hear and see my videos, Anand's videos, everybody else's videos saying, oh, you shouldn't have bought it. If you bought it, if you see a profit, sell it. Whatever. You see all that and you'll find it very hard to filter that noise, especially when it comes from people you admire and people you trust, them giving this information. It becomes very hard to put that on mute and say, okay, I'll hold on to this. I know maybe I should have done this, I should have done that, but I've done it now. Since I've done it, I will commit and I'll stay in it. You know, this doesn't apply to every other IPO. This is just using Hyundai as an example to say. So it also depends on the company and everything that makes sense. We have to analyze all that. But let's say you've entered it at a wrong price, you made the mistake or whatever. Don't overanalyze it and cook yourself unnecessarily if you're able to follow the first rule, that is. The first rule is most important, which is you're able to hold on to it indefinitely.
Right. So let's move on to the next lesson I learned from Uncle Charlie, and that is intrinsic value and paying a slight overvaluation for a quality company. So when we look at companies, we have this number in mind that I want 10% return from this every year, or I want 20% return from this every year. Okay, that's great. You have a number in your mind. That's a good yardstick. However, when the market is overvalued, sometimes you don't get the correct valuation that you want on companies. But money needs to be invested at some point. So a lot of us, what we do is we just hold on to our cash forever and don't invest. That's a mistake to make. I have made that mistake and I have regretted making that mistake. And what I learned from Uncle Charlie is that even though there are companies which are slightly overvalued, like for example, if you have a company that is trading at a price which is maybe 15% above its intrinsic value, but it's going to compound at, let's say, 25% year over year. The intrinsic value is going to compound 25% year over year. I am happy holding that company because, yes, I may not have made the ideal return I want to make, but I'm still making a much better return than I would if I just hold on to cash. This is not a call for people to suddenly go and jump into a company like Asian Paints at sky high PE values. This is rather for people to understand that you have to do tiffin coffee investing, because at some point your portfolio size needs to grow slowly, and it needs to grow steadily. And if you don't do tiffin coffee investing thinking that you're going to wait for that right PE to come by, the opportunity will fly by you and you will have been left in its dust. What do you think about this lesson I learned from Charlie Munger?
This is also very true. For example, we take case in point Tata Consumers. Tata Consumers has gone through a recent correction because the fast moving consumer goods section in India, the whole sector as a whole, the earnings has been average or poor in that, and the future also looks rather dim. So stocks like ITC has been taking a beating, and Tata Consumers has also been taking a beating. Tata Consumers is not taking a severe beating as what ITC took, but it started to take a substantial beating from where they were in their highs. But the problem is, we always look at the PE, as Shashwat said, and we'll look at it and think it's too expensive. It's a Vairu, say, as my brother says, it's a diamond needle. So you have to take a judgment call here. You will have to take the 10-year spread of the PE of Tata Consumers and see where does it land in an average. And is it worth venturing? Let's say the average PE of Tata Consumers is 40 for 10 years. 10-year averages is at 40. And now it's come down from 80 PE and it's come down to, let's say, 60. Are you willing to pay that extra 10, 15% or 20%, what Shashwat is saying, to acquire Tata Consumers in your portfolio and start adding it slowly whenever you see opportunities like this in a correction? Because yes, ideally it will be great to buy Tata Consumers below the median PE of 40 at maybe 40, 35 or 30, like ITC is at, but you're not going to get it in any time soon. Instead of keeping the money waiting for you, you can think of investing. But then again, keep in mind to buy at least close to where the median is, because you don't want to overshoot yourself and, like Shashwat said, buy Asian paints or something which is astronomically higher than where it should be, and then think, oh my God, I bought something which was way too expensive. So keep that in mind. You should not justify and use confirmation bias to justify your purchase. So as you follow these rules, do make sure you're actually doing calculations and you're actually being unbiased in your actual choices.
Yes. And speaking of that, let's move on to the next point, which is avoiding the clever trap. Why do I call it the clever trap? I'm calling it the clever trap because one, a person I read known as the Rational Walk also calls it the clever trap. But also, I agree with that name because investors often become their worst enemies. I mean, most of us think that I'm competing with this other group of, like, this mob of investors who are trying to outcompete me and take all the returns from the market which I should be making. That's not true. You are your worst enemy, in the sense that a lot of the mistakes which end up clipping your returns compared to what it could be, those mistakes are made by you. And some of these mistakes are trying to outsmart the market. You don't have to outsmart the market in order to make a good return. We are case in point. My uncle and I have an average IQ, maybe even maybe even that's debatable. But the point here is that we
True.
aren't geniuses. We're not the Einsteins of the investing world. But I'd like to think that over the 10 years, under the mentorship of his older brother and my uncle, I think we have made quite a decent return. And the reason we have been able to make a decent return is not because we're smarter than a rocket scientist or something like that. We simply follow the principles which people smarter than us have outlined, which is buy and hold, buy below intrinsic value if you can. Don't panic when there's a market panic. Instead, try to buy a little more when the market is panicking. Always stick to fundamentals. If you remember these things, you don't have to be clever. You don't have to say, okay, I'm already at a 20% profit on XYZ stock. If I sell it right now, when it's falling, I'll hold the 20% and then I'll buy 20 more shares when it's 15% lower, and then when the market goes up, I'll make 80%. No need to do all this. Even like saying it out loud made me feel tired and mentally stressed. So the point here is that avoid trying to be clever, because more often than not you end up becoming your worst enemy. What do you think about this?
I agree. And the biggest lesson you can learn from this is a plan is as good as its execution. So if you don't execute the plan you have, and you sit and you keep on reiterating, iterating the plan and working on it and trying to fine tune it, you'll end up missing opportunities which are there. People who are very successful in the market or successful in anything in life, just being consistent. Consistency is the key to all of this. It is not intelligence, it is not cleverness, it is not some kind of secret ingredient into success other than being consistent. And that is a power of value investing and compounding. It only works if you're consistent. And as long as you're consistent, you will definitely be successful in value investing and in compounding. People who do this trading, who try to do future and options, who do all this algo nonsense, are the ones who need to be clever and try to outsmart each other in trying to bet one against the other. In value investing and in building this kind of wealth, There is no gambling. So you don't need to be very smart. You don't need to measure odds. You don't need to measure probabilities. You just need to see if this is a good business. Do you understand the business? And are you willing to own the business for life? If you are, then you start buying the business at levels which your risk appetite is satisfactory for you, which is what Tiffin Coffee range is all about, which is a risk where you don't mind losing that money which you're investing today. If it disappears and becomes zero today, you don't mind because it is at level, at a risk level where you can stomach it. So I agree with this.
Absolutely. So, two more points which I've learned from Charlie Munger. First point, cash doesn't equal options. This is maybe opposite to what we have been talking about in a lot of the seemingly opposite, but let me clarify. What I'm trying to say here is that Charlie Munger has taught us that if we are retail investors and not a Warren Buffett sitting, on a throne where he doesn't have many more options, it makes sense for small people like us to take our money and put it to work where we think that we could make a decent return given market conditions. This doesn't mean that you have to take all your money immediately and invest in lump sum in XYZ stock or XYZ index and then end up feeling very bad when the index goes down by 5%. That's not what I'm saying. What I'm trying to say here is that it always makes sense for small time investors like us to try to look for opportunities, because for Warren Buffett to move the needle, he needs to find a company the size of Apple and then buy it. But for, let's say, a Vinod and a Sashwat to move the needle on their portfolios, they just need to find one good stock and maybe buy five of those stocks. And that means your portfolio has already consists of, let's say, 10% of that company. So to move the needle on our portfolios requires a very small amount of money, which means that we can find such opportunities to be able to move the needle in our portfolio. Whereas if you try to emulate Warren Buffett and say, look, he's sitting on $350 billion of cash, but I'm sitting on, let's say, 10,000 rupees of cash of pocket money or whatever I've saved up. I can buy one share of Dr. Reddy and half of my spend money would go away. So the point I'm trying to make here is that finding one good opportunity could mean moving our needle. Whereas for Warren Buffett, it's very difficult to find such an opportunity, because even if you were to take over a company for $200 million, wouldn't make any sense in his portfolio in terms of returns. What do you think about this lesson?
I agree. I wholeheartedly agree with this. And one of the biggest ways to save yourself from having too much cash is to keep investing. The problem is always we all think if we accumulate a certain amount of cash, then we're going to go invest. I want to create a war chest. But problem is life keeps happening, our mind keeps changing, and then we find ourselves touching into that cash pile and taking things out of it. And unfortunately, when that moment comes, we won't have that cash. So you're better off if you have problems like me where keeping a cash in an account, you end up spending it. You might as well start spending it on investing. You start investing it, and that way you don't run into this problem of, oh no, what do I do? So I agree. And like Shashwat says, our needles move in very small volume of money moves our portfolios in big levels. So keep pegging away at it in a small level space, and you'll be fine.
Absolutely. And finally, if all of you have been continuing to watch this video, I hope you're getting some value out of it. Let's look at the final point of this video: psychological strain. What do I mean by this lesson? This is the most important. Even if you have listened to all the other lessons which I've learned from Charlie Munger, I would argue, and I'm sure my uncle will agree with me on this, this is the most important point, which is avoiding psychological strain. If you put yourself in a position where you are constantly worrying about a 1%, 2% gain or drop, or even a 5% gain or drop, I'm sorry to tell you, but your portfolio is creating needless stress. I will repeat, if you worry about a 5% move up or down, I'm sorry to tell you that your portfolio is creating needless stress. In the long run, holding quality stocks will prevent that mental stress from accumulating, knowing that even if the market goes down by 15%, all you need to do is buy more of that stock if you think the fundamentals are strong, or you feel comfortable just holding on to it without thinking about whether you need to sell it or something like that. So the point I'm trying to make here is that if your portfolio is causing you to worry about whether your stock is going down by 5 10%, and if your worry is not whether I should be buying more, then I'm sorry to tell you, but your portfolio is creating a lot of stress for you. And stress, I don't mean to sound I don't mean to sound cliche. I'm not trying to say platitudes, but stress kills. So if you want a longer runway and you want to be able to get the most out of your investing journey, you have to avoid stress and you have to avoid having a portfolio which causes stress. What do you think about this point?
This is very true. This is something very simple in psychology which you can explain is human beings, we are creatures which love narratives, who love stories, and we follow stories. This is the main reason why people like our political leaders are elected the way they are, because we consume stories. So we have this narrative mindset. And another thing which human beings have is negative always seems much bigger than any positive. So if you have 10 positive news in your life and you have one small negative one, that one negative is far bigger than any positive you have in your life. And another thing which we do is we look for confirmation bias. That means we go around trying to confirm whatever we believe in. So that all these three things work against us. We listen to a story, we take the negatives, then we go around in the world trying to look for news and information that confirms our negative. And we get into this loop. So what Shashwat says is very true. Don't go on looking at your portfolio. Don't look at this, how much I've lost in my portfolio. Don't do that. You should not bother about that. The only way you should look at it is you only look at the list of companies name wise. Then say, is any of these companies or businesses I don't want to be in anymore? Or am I happy being in these businesses? As long as you look at those names and those names are okay, you just keep buying value whenever you see it. Don't worry about the price. Don't worry about how much it's valued at today, because like I said and Shashwat said in the beginning, we are buying it for life. So it doesn't matter to you. If you are honestly buying it for life, it doesn't matter if today it's 10 rupees, tomorrow it's 100 rupees, or if it goes all over the place, because you're investing in the business for life and you keep buying it. But it's a very difficult mindset to have. And everyone can say, dude, that's very easy for you to say. How can you say that? I'm not saying this is easy. But if you want to create wealth, you have to have that kind of an extreme mindset. As that saying goes, you aim for the stars, you may land on the moon. It's that kind of a mindset. You have to push yourself to that level. Only if you're willing to push yourself to that level, you may at least get halfway there. If you resign, saying, though, how that's all nonsense, it's impossible to do this, then it becomes difficult. You defeat yourself even before you start.
So these are the 6 points. I hope you enjoyed them, because I know that I enjoyed discussing it with my uncle and asking for his views on it. We will continue making videos like this, but if you do like this video, do leave some feedback in the comments so we get to know what your opinions are.
So thank you for watching this video. Do put in the comments down below. We're trying to do these kinds of these kind of videos on the weekends when the markets are closed. So you get a little more time away from your work and away from market to spend a little time about thinking about the psychology of investing. So that's what the intent behind these kind of videos are, especially in the weekends. So give us your feedback. What more would you like us to focus on? Are you finding these videos helpful? It'll help us to curate these kind of videos better for you in the future. Thanks for watching the video again, and we'll see you in the next one soon. Thank you.
Thank you. Hey guys, that my uncles VinodSrinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.